Good afternoon, good morning, wherever you are at. It's great to be with you today. Excited to be bringing you this webinar and this presentation. Popular topic, one that's been on the minds of a lot of our clients and prospects, and hopefully on your mind as well. So enhancing month-end close with advanced reporting. A lot to go through today, but first we want to walk through who we are and get ourselves introduced. My name is Jim Ashley. I'm a partner here at Forvis Mazars. I lead our outsourced accounting and services practice. And with me is Brian Singleton, a director in our outsourced accounting and services practice. He's our technology tools team leader as well, and does a lot of system implementation and guidance and consulting for clients. We work a lot together and have worked together for a handful of years now, and excited to be bringing this topic to you today. So today's agenda, we're going to hit some objectives. We're going to walk through a practical application of financial reporting. We're going to go into what is beyond the standard financial reporting. And then we're going to take a little bit deeper dive into cash flow reporting, because that's a primary driver of planning and compliance reporting as well. And then we'll conclude today's presentation with a brief discussion on tools out there in this business environment. All right, so what are the objectives? Well, we certainly want to go through the process of understanding what options are available for accessing your financial data. That's the probably number one place to start. Are there multiple sources? Is there one source? How do you get that information together? And then objective number two, what do you trust? What's that source of truth out there? And is there a way to integrate that? So can you identify that single source of truth of data and to integrate all your systems? Some of you may already be there, some may have some challenges, that may be a totally new concept. Then lastly, finding more meaning in your financial reporting. We as accountants and finance professionals, we are in the weeds every day, and sometimes you are totally focused on a task, but you need to take the time to look at the big picture, whether that be weekly, monthly, and certainly making sure your stakeholders, whether internal or external, have a clear understanding of reporting as well. So that could involve your KPIs or any other reporting beyond the standard financial statements that you see in most accounting closes, the balance sheets, the income statements, and cash flows. So that is the objectives for our presentation, and I think we're going to queue up our first polling question. And just a reminder, you need to get 3 of the 4 of these to get your CPE credit. So I'm going to read this question and give people just enough time to plug in their answer. So when is the last time your accounting and finance team updated or enhanced month-end reporting? So does this occur often? Maybe not often, but sometime, within the last 12 months or so. Is this more than a year or more than 12 months ago? Or I can't recall ever seeing this change being made. So really curious for the results of our first polling question.
And maybe another question to ask, I don't know if we can solicit answers in the Q&A, but when you do update month-end reporting, what's driving that? Like, what are the factors that make you go out there and say, hey, we need to change things up a little bit? Is it new business lines? Is it budget or fiscal year focus?
By a small margin, a winner that this occurs often. Second place at 33%, so basically a third of you, slightly less. Not often, but certainly within the last year. Maybe a fifth of you said, hey, this has been a year. And there is about 15% where you don't recall this change having ever been made. So interesting results there. Looking forward to going to the next slide. And I'm going to hand this off to my co-presenter, Brian, to get us kicked off here.
So the first thing we want to cover is some of the basics that go along with your basic financial report, some keeping things in good order, how to get some foolproof financial reports out there, reliable financial reports. It's not a needle in the haystack if you expand or contract your business to get your standard financials complete. And it all starts with a good chart of accounts. And what I mean by that is how it's indexed and ordered. And typically, most financial report writers use some sort of numerical values to create line items on a financial statement. So, is your chart of accounts in a logical order? So that means are all types of accounts, do they start off with the same digit or two digits or maybe even three digits? Can they be grouped together using a range of numbers to then create line items that trickle down to your financial reports? So that's the first thing we want to look at. And is it pretty obvious to an outsider looking at this? What are these groups as they go down the chart? And most importantly, are you consistent across your various entities or business units? This really helps with consolidations, obviously, is keeping that consistency so you can get consolidated reporting to actually line up. Another thing to consider are there is your account numbering structure linking balance sheet and income statement accounts? So, for example, do you have prepaid insurance in account? Maybe tie the last two digits in that account number to the expense account itself. That way, muscle memory helps your accounting team remember accounts that are linked together from a capitalization and an expense standpoint. Next thing to look at is there an industry standard chart of accounts for the industry you're in? And if so, that was probably built for a reason, taking care of like a lot of these logistics I just mentioned ahead of time. It also helps with M&A activities so that any potential buyers, anyone doing due diligence can really break apart your financial statements and understand what's going on there. So always be wary of industry standards and how that plays into the structure of your system. And then finally, does your GL system or ERP use what are called reporting dimensions? And these are like tags or flags that you can place on transactions. These take the place of these traditionally very long strings and chart of accounts that identify things like departments or projects or locations. It's a way to shrink your chart of accounts so that you have natural accounts like supplies, and then you use your department and location or maybe project or other tags to identify where these things need to land in advanced reporting. So this is always a good thing if it is available in your system, please use it. Don't rely on the traditional string. But if you're evaluating new systems, always something important to look for here.
So, Brian, that I'm glad we started here because I'll tell you just, from my career's perspective, early on in my career, I was an auditor my first year. And I remember, the first thing you do as an audit staff is getting the PBC's trial balance imported. And you'd see all variations here of charts of accounts. You see some that are very concise and clean, and those maybe weren't very complex industries either. And then you would see some very voluminous, to put it mildly, charts of accounts, where it seemed to just go on and on and on. And then you'd see with those clients, a lot of those general ledgers had a zero balance. So massive, massive charts of accounts. And, your first year staff perspective is why'd they do this? And then you move on. But as you kind of grow throughout your career and get to the point of financial planning and analysis, I think it's exceptionally important to borrow the phrase, to begin with the end in mind when you're looking to build more meaningful month-end reporting here. And working with you and working with other colleagues and consultants, especially as we work with clients with system implementations, I've learned, and I cannot stress enough, how critical it is to review your chart of accounts, set up a structured format, a logical format. You have to work with the key stakeholders to make it understand the meaning behind it, what you're trying to, goals you're trying to accomplish, and ultimately what you're trying to measure out of those financial statements. So just, observationally, that's what my experience has been early on in my career versus, when you move up and do more financial planning and analysis, real critical key component.
And the main point here is this is to help speed up that month-end close so that when new things bubble up, you're not going on a hunting expedition to figure out mainly what they are.
Yeah.
So if you have a new line item all of a sudden appearing, if it's indexed in a logical order or tagged appropriately, you're not all of a sudden it's not a race to figure out what exactly is this thing. So the idea is we're reducing that time to close here. So the next thing we can do in taking steps to shorten that month-end close is to consider automation. And I have accounts payable highlighted on this slide because this is the lowest hanging fruit we have out there at the moment. And it's been a long time coming, but we're finally here on eliminating human interaction with accounts payable, or at least the data entry side of accounts payable. So there are all sorts of options and tools, and we'll discuss tools later, out there that can read and post, or at least submit for approval, bills coming in from your vendors. So this is by far the highest ROI of any product out there, is going to either, if your accounting system has some sort of AI or optical character recognition built into its AP module, several of them do now, use that, begin using it. You can email in bills or scan and upload bills. It cuts hours and hours off of the AP process. And increases accuracy, which ultimately, ends up in reduced time to close. So this is absolutely the place to start, AP and automating that in some manner.
Brian, that's the expense cycle is one of the primary accounting cycles. And, the thing with this is it's great that these tools are out there, and a lot of these can segregate duties and allow for functionality for management approval, payment initiation, all those things. That's wonderful. But really at the front end, it still takes that good accountant mindset to, the AI may queue up something for you, like, hey, we think it's this. You still have a responsibility to make sure that's accurate. And then ultimately kind of question that transaction too. Is this categorized as an expense, or should this be a prepaid? What is the timing of this? It may have a date that it picked up, a invoice date, which may be different than the date of service. So you have to think through cutoff. So you still have to have that account mindset from a review and oversight perspective. But I totally agree. This expense cycle is probably one of the largest changes we've seen in the last 10 years in the accounting and finance function.
And at the end of the day, it doesn't eliminate the need to make decisions like you mentioned, but it does eliminate keystrokes and clicks, which is what we're trying to do here. So along those lines, same thing. A lot of platforms now have bank feeds available, which help with bank reconciliations. So you program matching rules or even transaction creation rules that are coming through your bank. So that way you're not sitting down with your printed bank statement and ticking off your cleared checks and then clicking them in your accounting system or whatever you're doing to do your bank rec. The system can match check numbers and amounts, and sometimes even payees on your checks, and clear those out and leave you with a half dozen to a dozen items that you actually need to consider when doing the bank rec. So another way, these bank recs can take the most amount of time you have in a month-end close process. You can cut that down by, 90, 95% if you have these bank reconciliation automation capabilities enabled in your system. So if you don't, it's something to look into tomorrow, or why not even this afternoon. And then the next place we want to look are any API integrations. API is short for Application Programming Interface. This is basically a open standard that allows you to connect one system to another if both systems are cloud-based, and that essentially means you access them through a browser. And you can program transactions to when they trigger in one system, they can push and pull from one another, or update, or create one-way syncs. There's all sorts of options there. But the idea is you're not pulling information off a report from maybe a point of sale or another platform and entering into your accounting system. So we always want to explore API integration options. There are a plethora of them out there that are pre-built for most systems. And by the way, today we're primarily discussing QuickBooks Online, Sage Intacct, and NetSuite. I know there are others out there, but those are the three platforms we have the most experience with. And all three of those have API options available. And just because the systems you're trying to connect are not listed on your publisher's marketplace doesn't mean you can't hire a third-party developer to build a connection. There are a lot of great developers out there these days that can do things at a very reasonable price. Okay, so,
Brian, go ahead, on that one, what comes to my mind, and a couple of examples. One, the payroll cycle, another big accounting cycle. And, the advent of automated payroll the last 25 years, you have all the large providers, and then there's been a good growth of a lot of smaller providers too, with a good payroll infrastructure. So a lot of times you'll see, what was available 5 years ago may have been, hey, here's your journal entry from the payroll company, where it was still a manual recording, versus some have now a direct integration, or somewhere in between where there's data that you're looking to connect. So that's one big cycle that comes to mind, an opportunity for certainly curtailing down the period end close. You also see a lot of opportunities with those payroll providers for other data in there, whether it is tracking accruals related to benefits and getting those posted. So there are opportunities all over the place in payroll cycle with respect to that. Then, Brian, what have you seen with, on the rev cycle with point of sale? Was that another good opportunity?
It's like you were reading my mind. I was going to mention those are the big ones, payroll, and then connect. And we'll talk about this a little bit later in the presentation. But connecting that source of truth or source of information for the sales cycle. So more often than not these days, we are managing the revenue cycle in a separate system from our accounting system. Now, that doesn't mean that we like 100% of folks aren't issuing invoices out of their accounting system, but more often than not, revenue is managed elsewhere. So looking at how do we get data out of those systems and transmit it into the accounting system of record is really important to speeding up that month-end close process. And one of those options might be an API integration. And then sort of one step down from an API integration, next bullet you see here, I have listed as data transformation. And what I mean by that is taking native reporting from this source of truth, be it a payroll platform, your sales system, maybe some other application that you're trying to grab information out of for accounting, and putting it through a process that you can then just upload into your accounting system. So maybe download a flat file, and there are tools out there. We'll mention these in our tools section at the end here. But there are tools out there that you set up once and can flip these flat files and upload them into your accounting platform, sometimes even automatically, so that there is still some human interaction needed, but the actual rekeying of information goes away, and things become a lot quicker and more accurate than keying things into like a journal entry template or some sort of Excel file to give you calculations. A lot of that can be done automatically using these data transformation tools. So and I'll just say it has really, these type of tools have really helped our practice specifically and evolve in how we help our clients. We can get a lot more done when we're not just rekeying information from a system of record into the accounting system. And they're oftentimes, these tools, like either free, they're pretty easy to learn. So it's a great option without going all the way up to a more advanced API integration.
I think, Brian, same holds true here, though, with the comment on accounts payable, and that, you know, I'll call it the accountant's troubleshooting instinct and ability. You can get a lot of data in, but is the data accurate? And what happens if there's an error with the data? So being able to accurately troubleshoot and resolve issues in a timely manner is a real critical function. And having that accountant and finance know-how, that level of experience, what to look for, that's really critical for success here. So you can have a lot of bells and whistles, but if you don't know how to troubleshoot, you better find someone that can help.
Yeah, not only that, just having an understanding of how the data actually flows, right? You don't have to know every single nuance of it, but understanding, like, okay, if I'm having an error, what might be at least causing that error really goes a long way to getting those things resolved quickly. And then another place to look, we touched on point of sale, but just managing your customer receipt process specifically. That's usually a very labor-intensive process. Really dissecting what that is. This is a huge issue in healthcare. It's a huge issue when you're a business that deals like with a high volume of credit card transactions. So taking a hard look at that process, really dissecting the components of it and how can we speed that up. Is it via some sort of clearing account where you can isolate discrepancies between your system of record and your accounting, or what's flowing through the bank, ultimately in the accounting system, rather than trying and eliminating the spinning of wheels of matching up cash clearing the bank versus what your point of sale is telling you. We don't have any, I'd love to walk people through a case study here, but there's just a wide variety of things that can happen. And I think the most important takeaway here is really dissect the process and understand how you can isolate discrepancies and fix them without holding up the accounting process. All right, next slide. We touched on this a little bit, so we'll speed through here, but we want to identify and manage some of our bottlenecks. And the first thing there is what things are being tracked in spreadsheets and why are we doing it? Are we keeping this separate spreadsheet out of our accounting system for any particular reason? Prepaid expense amortization. Depending on how modern your accounting system is, you might be able to recreate that spreadsheet directly in your accounting system using some of these dimension tags we talked about, like a prepaid expense siphoned out by your vendors. You can sometimes get reporting built natively in your system that will give you that same amortization schedule that you might be keeping in Excel. If you've got like a debt ledger or some sort of debt report where you're tracking all of your loan balances, there might be creative ways to address that in your accounting software directly so that you're not constantly updating this secondary spreadsheet. So take a look at every spreadsheet you have, really understand, like really put thought to, is this something we can track directly in the accounting system or one of our other systems of record?
Brian, a quick anecdote, just my experience with at the time a prospect, and they love data. They love tracking data, both accounting, finance, but operation, and really marrying the two. They had some spreadsheets, but their business office was filled with whiteboards, and it was just like all over the room, whiteboards. And I got the concept of writing things on a whiteboard can sometimes do some magic in your brain, but I was bold enough to ask the question how long that took, and it took hours to complete that. And who knows if it was accurate. You know, we always talk about the risk of spreadsheet errors, whether that is human error or too much data in the spreadsheet. Imagine that in a whiteboard scenario, a lot of risk there as well.
Yeah, absolutely. Anywhere where we're keying in the information, something can go wrong, no matter how precise you might be. If you don't have the appropriate checks in place, that could go sideways really quickly. So some other bottlenecks might be you're waiting on information for transactions. I know I need to post this particular transaction at the end of every month, but I need that information from a third party. Is there a way to record that, an estimate on that transaction? Is it linked to a percentage of sales usually? Is there just a way to get over the hurdle if this one thing or two things or maybe even three are holding up your month-end close process? Is there a way to estimate this as accurately as possible and then retroactively adjust using some form of automation? Again, a lot of automation options out there, particularly in Sage Intacct and NetSuite, that you can retroactively adjust, maybe an accrual or something else that you've booked after the fact. So just think creatively in that regard. I know we're accountants and we struggle to think creatively sometimes, but think about ways that you can come up with estimates and then go back and fix them or adjust them later. And then finally, something I have experience, I have 11 years of experience in industry, and there's always that push-pull with operations or sales. I need this information from operations before I can proceed. They don't understand what our life is like in accounting. We're the most important ones, where actually they're out there making business actually happen on a day-to-day basis. So we have to be considerate of their time as well. We always think we take priority, but honestly, they are making business happen for us. So we want to eliminate any barriers that they might have to submitting the data we need. So is there any way at all that first of all, that we can pull information directly or schedule maybe reporting to end up in accounting's inbox? Look at that first. How do we have like cloud storage where they can land information into cloud storage so that they're not even having to download and email anything? The main thing is we want to eliminate every barrier possible for them submitting that information. And then I think just this kind of goes to the human element side, but just develop rapport with the people you need the information from. Explain why you need it and how it holds up what you're doing from an accounting perspective and how that trickles down to the rest of the business. I think rather than just saying I need it, always explaining the why and adding that human element there is important when it comes to sales and ops.
Brian, we have a colleague, you may or may not know that when she was in industry, she had a policy from ownership that the accounting and finance team spent a couple days actually in the field in operations, and likewise operations, so they get to feel each other's pain, and that can go a long way for that effective communication and building rapport with the teams, because you're really working together here. If you're not aligned, then I guarantee you that's going to drag out your close cycle.
Yeah, and it's a classic battle, sales and accounting. It happens in every organization, and I think, you know, having a good EQ there and how to sort of manage that process goes a real long way to getting the information you need. And it looks like we've got another polling question here. How many sources of information are you referencing to produce month-end reports to management? So we've got 5 or more systems, 2 to 4, 1, or you're not sure, or don't know. So I'd say in most small to medium-sized business environments, you probably have at least 2. Payroll being one big one, and then that sales data platform being the other. You might have things like CRM, maybe other points of sale out there. So you might have one primary points of sale, but you have people in the field carrying around their Square readers to take credit card transactions. So probably most people have 2, but usually there's probably more.
Yeah.
And it looks like 2 to 4 is our most popular answer here. 5 or more, that's a higher number than I was expecting. And single coming in at 15%. And of course, I'm not sure, 12%. All right, so it looks like we need to pick up the pace here a little bit. So let's hit on some more approaches to more of the basics here. And the final part of this section is looking at how do we optimize reviews. So we've produced the financial statements. We've done all we could to actually get them done, but somebody's got to look at these things before they go out to the various stakeholders. So we want to, it's really all about access. We want to give reviewers access to the financials on their terms. So it used to probably, back even before my time, it was print these out and circulate them through interoffice mail, which ultimately evolved into on the 10th of the month or the 15th of the month or whatever day, the 3rd Friday, I'm going to email these reports to everybody, and then they're going to give me all their commentary back, and then I'm going to make adjustments and then send a final version. Now in a cloud-based world, we have the ability to give the reviewers access to information anytime, any place. So if you're still sending out reports via email and hopefully not interoffice mail in the brown envelopes with the string, if you are, please cut that out now and look at other ways of sharing these reports. So either have a native cloud-based system, or at least some electronic format of your reports that you can put into share cloud storage that folks can access at will, and they're not waiting on email from you. Consider, like, if possible, even issuing interim financials throughout the month. That makes things a lot quicker for reviewers to look at maybe individual payroll cycles or expenses that are building throughout the month, so it's not one huge review at the end of the month itself. Another quick way to help is create targeted variance reporting. So, you know, prepare some reports, and some systems can do this, where you're only looking at line items that have 10% or more variance to budget, or X amount of dollars threshold, So that way you're not spinning your wheels on accounts that really are meaningless or do not have much of an impact on the financials. And then along those lines, really only focus on the things that are important or material. Again, don't spin your wheels on $100 of expense. You could have issued these financials days ago. Finally, when you're talking about review, you want to think like the owner. Okay, so again, focusing what is important. The best way to do this, though, is after you've prepared the financials, it is really tough to review your own work. So you want to mentally detach from the production process. So give yourself at least 2 hours to come back, go eat lunch, go do another task, and then come back and take a look at these financials. And really put on the hat of ownership. You probably know your owner or your various stakeholders very well. What do they always ask about? Go there first and analyze the line items you're going to get asked about and have answers. If there's anything else that might stand out, any large variances, any weird trends, look at those, drill in, find out and document why. Have those answers ahead of time before you issue the financials to the various stakeholders. Okay, so we're going to go into more advanced reporting now that we've kind of covered how do we streamline month-end close. Let's talk a little bit about other things that can be done. So just want to take a quick look at where we have been and where we are now. Of course, we had the old pencil and paper, maintaining everything in subledgers, do a batch close at the end of the month to the general ledger. We're producing financials from the general ledger. Then came the advent of computers. That really helped with the data entry side of things, but really reporting didn't evolve at all. You just didn't have to type the reports anymore. The computer did that for us, but we still kind of only had access to the traditional balance sheet, income statement, cash flow statement when we moved to the computerized version of accounting records. And then finally, here we are today. A lot of accounting data is now in the cloud, and that has opened a whole new world to things like dashboarding, reporting, and other KPIs. So let's talk about that a little bit. So the first thing we want to do is identify your systems of record. So what all is out there? And then come up with a plan to pull out accurate information from those systems and then how to translate that to your accounting records. So we mentioned points, a singular point of sale or points of sale. So if you've got multiple revenue sources, you want to consider every point of sale. I think that goes without saying. Maybe electronic medical record system if you're in the healthcare industry, or whatever billing system your particular organization is using. Sometimes that is native in the accounting platform. Don't forget that your secondary sources of revenue are often missed. So a good way to identify these is what kind of receipts are hitting your bank account? What are the source of those receipts? I brought up the idea of a Square platform. So maybe most of your business is done via traditional point of sale, but you have people out in the field, if you're retail, with handheld Square terminals. Don't forget about those as our way to grab reporting from those, and then transform that data into something you can use in the accounting system. So once you've identified all of your sources, let's look at things beyond revenue that we can use to produce key performance indicators. So maybe things like customer counts or transaction counts or number of users of your system or your app or whatever it may be. A good way to do this is take a step back and look at how you're trying to forecast and budget. What are the things driving your forecast and budget? Is it customer count? Is it active users? Is it something else? These are good things that we want to pull out of your systems of record, other systems of record, and then find a way to get them into the accounting system. Maybe headcount's a driver of your business coming out of payroll. Maybe you've got some sort of usage-based revenue model. So getting usage information from your ops system. And then when you combine that with your financial data, what can you learn? And oftentimes this is how you're trying to budget in the future. So is it revenue per customer? Is it revenue per use? We have some clients that are movie theaters, so looking at average cost of ticket to each film is an interesting metric. And then same goes on the expense side, like what sort of usage statistic is driving your expense here. So then, as I mentioned, when you're combined with your financial data, what can you learn? Some things here to consider though. What's important to your stakeholders? So that means what's important to your industry, what's important to your managers, what's important to your lenders, and what's important to your investors. So almost like a backwards approach. Look at those items. How do we get there? What not only financial data do you need to get to those metrics, but what statistical data do you need? And can those be pushed into either your accounting system or some sort of third-party reporting system to create these KPIs? That takes you to the next step. How do we show all of this information to our various stakeholders? And there's 3 and maybe even 4 options. I've broken them down into a couple of different categories. Spreadsheets, your native accounting system, and then a dedicated financial planning and analysis software. So we've got pros and cons listed of each here. So please take a look at this. I believe the slides will be available later. But as we're running out of time, I don't want to take away from some of the cash flow aspects we want to discuss here in the last 10 minutes or so. So I think with that, let's jump to the next polling question. And let's see here. Do you think your management team would appreciate enhanced month-end reporting coming specifically from the accounting department? So we've got the answers yes, if they understand why these metrics are important, maybe, or I don't think so. So pretty simple set of answers here. Want to see if we have anything in the Q&A here that we need to get answered, Jim, while we're waiting for those.
Yeah, Brian, a really interesting question was queued up here. We were talking about, if it can be done in the accounting system instead of an outside spreadsheet, you should attempt to do so. So one of the audience members asked, hey, if you're entering all the information in the accounting system, what is used to reconcile back to? So for example, is it a debt schedule, a lease schedule, et cetera? So just the audience member was curious for your analysis there.
Well, let me flip the question there. If you're taking information and plugging it into a spreadsheet, are you reconciling back to anything if you're producing that spreadsheet? So if that's the case, if you're just entering data into a spreadsheet to track information specifically, why not, if you can, why not just have that live organically in the accounting system itself? Yeah. Now, you do want to tie back ultimately to something, either a source transaction, and maybe you're like in the simple example of like an amortized prepaid, you want to maybe prove that whatever you're tracking within the accounting system actually ties out to 10/12 of the original transaction. Now, a lot of these you can include maybe start date, what the original transaction was, so you have that information available visually to make that calculation either on a calculator or in your head. So there are ways to include needed information directly in the accounting system via custom fields or other options.
Yeah, that makes a lot of sense. And so the polling results, yes, if they understand the why, a sounding majority there, nearly 73%. About a fifth of you were not sure if management would appreciate it, and less than 7.5%, didn't think management would appreciate that. So, I challenge that, only 7.5%. I'm glad to see such a low number there, but hopefully there's circumstances where they could be more involved with respect to that. So, okay. I'm going to take us next with cash flow analysis as a part of month-end reporting. Really want to kind of talk through the analysis between what is a cash flow from a GAAP perspective versus a cash planning perspective, or compliance versus, I may dare to say, practicality. Not implying, of course, that GAAP isn't practical, but nonetheless. So really, when we're talking about GAAP versus cash planning here, there's some objectives to kind of think through of what's the purpose, who's the audience. Well, big picture, GAAP, you're really kind of focused on those external stakeholders versus cash planning. It's really the internal operations team, accounting and finance team. How can we manage cash more effectively, et cetera. Then from a reporting and structure format, the cash flow statement has a very defined set of reporting. We have a slide coming up on that versus cash planning. It's really kind of up to you. We just talked about spreadsheets. You can design your own. There's a lot of people that do that in the Ashley household. We would kind of have a cash flow planning. Hey, we want to go on vacation next summer. What do we need to save up for? What do we know bills that'll be coming out, et cetera, et cetera. So even at the household level, you have that sort of analysis. So it can be very customized, or with your planning, or with GAAP, it's got to be very strictly adhered to in order to maintain that compliance structure. The timing of it, so it's ongoing for cash planning, right? It's a tool that you're constantly looking at, probably with your AP cycle, I would speculate, or your payroll cycle, or big outgoing cash functions. You want to have that ongoing check-in, likely weekly, sometimes more frequently, sometimes less. With the GAAP function, the cash flow statement, again, if you have quarterly reporting requirements, you're really focused on getting that accurate every quarter, and certainly at year end with your financial statements to third parties. Your focus and detail, you're looking backwards with the GAAP compliance, like, hey, how was our cash flows over the period that has closed, versus prospective guidance when you're planning on cash projections and analysis. You're looking at potential inflows and outflows there. And then, metrics and analysis, you're getting into with GAAP, like the operating activities, the financing activities, et cetera. There might be some metrics you can pull out of that. Your analysis is going to be typically comparative. Hey, what's cash flow statement of this quarter versus last quarter, this year versus last year? Cash planning, you're thinking about metrics. Hey, what's your burn rate? What's your runway? Your liquidity ratios, et cetera. And then you're also potentially looking at like some stress testing and scenario analysis as well. So really, when you think about GAAP, cash flow statements, very rigid, very compliant, backward looking. Cash planning, very prospective, insightful planning, and a lot of flexibility in design there. Okay. So what does it look like? And here's just a quick breakdown of a very generic on both fronts here. The GAAP in terms of your operating activities, your investing activities, and financing activities, and you have your net increase or decrease in cash. I really like the cash flow statement. It's probably the one that took a little bit longer for my light bulb to go off early in my career, but once I understood it, it's a really neat statement for functionality purposes. But when you step out of the kind of third-party compliance perspective and get into the financial planning and analysis perspective, it's probably a little less meaningful. It still has value, but a little less meaningful. So really, when Brian says, think like your owner, well, what's your owner thinking about? Your owner's thinking about, I got bonuses coming up, or I've got a big 401k accrual that I've got to pay, or whatever these big outflows are coming up. Am I going to have enough cash coming in to manage that? Do I need to look at the line of credit? Do I need to draw on that? Or, if I have an acquisition coming up, how much cash do I put down on that? How much can we afford? Can our retained earnings cover that? So lots of different analysis there to consider. And again, very generic on the right side there from a cash planning perspective. It's you're thinking forward there. That's the big difference versus thinking backwards with GAAP. Okay, so just a couple more notes here, and then we'll get into the tools discussion. So really, when you're thinking about internally and understanding the cash cycle and automating your forecasts, I won't define all this for you. A lot of you probably already know that, and just to save a little bit on time too. But really, you need to have those kind of built in. And that could be built in with your dashboards, as Brian referenced, or built in with a specific financial planning and analysis tool. The FP&A tool can be a lot more in depth from a forecasting perspective and a budgeting perspective. Your general ledger can have a lot of built-in dashboards. It's really what the need or desire is of what you're trying to accomplish. But you need to have an understanding of the cash flow cycle in your industry. How much are we a service-based business? So what does payroll look like? And when does that time that we're incurring on payroll actually turn into revenue? Okay. So by the way, even though it turns into revenue, when does it turn into cash? That's the real critical function. So is the payroll that you incurred last August going to be collected in September, October, November? Again, really having a good understanding of your cash cycles so you can build your planning analysis accordingly is super critical there. So talking about defining the drivers, making sure you've got accuracy in that. And when you talk about working capital, the cash flow of the company, if you can tweak a couple days on collections and tweak a couple days on payables, you will see a big swing in the cash that's available to you. And what that means is a lot more breathing room for you to help pay bills and for your owner or board of directors to feel more comfortable at the end of the day too. So, and then lastly, wanting to invest in a platform, again, using dashboards built into your general ledger, or looking at a tool, an FP&A tool in and of itself is a great opportunity. So we're going to close with a polling question, and then we're going to, so for CPE purposes, and then we're going to talk about tools.
So mention some of these tools throughout, but these are some things we use. I know the audience is probably curious. All right, great, you talked about all of this stuff, but what do you actually use to do it? So we've broken down into three categories here: general ledger. So primarily, we're talking about Sage Intacct or Oracle NetSuite, but modern cloud-based GL platforms all have a lot of these same features and functions we talked about, including native dashboarding, this concept of dimensions, AP automation, things like that. When we talk about process automation, we use tools like Bill.com, now known as Bill, that for the AP process. In fact, Sage Intacct, I'm not sure about NetSuite, also has some AP automation options available. Expensify for employee expense management. Workato is Workato, I mispronounced that, is an API integration tool. And then we have some data transformation tools listed here, Alteryx and Microsoft's Power Apps. This is where you can take information from like a flat file or maybe even a web connection and transform it into data you can actually use in your accounting system. And then some reporting and planning tools, Derive, Fathom, Martis, Adaptive Insights, and Solver are all tools used at this firm. Jim, not sure if you had any others to list here or if we should probably move
I'll just
towards
say
the end
those
here.
are kind of brand names there, and the audience may be familiar with those, maybe not. But as you said, Brian, we have certainly seen these and are comfortable and familiar with them. A lot of them offer those direct integrations. You at the top of the slide there, you have the General Ledger, Intact, and NetSuite. From a small business perspective, QBO and Xero are also popular tools that we have familiarity with. A lot of these have direct integrations, which is phenomenal. And those are kind of the core 4 General Ledger packages, from like small to medium to almost enterprise level businesses, QBO, Xero, and then stepping up to an Intact or NetSuite. So those are all typically the GLs that a lot of these tools look to integrate with first, which is a great sign. And of course, kind of closes the circle we talked about at the beginning of having the sources of truth instead of having addendum spreadsheets that have risk of human error or data error. So, okay. Well, I think we are right at the end of our hour here, and we're at the end of our deck. So it's been great to talk with you today. Hopefully you found this presentation meaningful. We'd love to hear from you. Thank you for the great questions throughout the presentation. But this will be Jim and Brian signing off, and have a great rest of your day, everybody.